Do the gains you see on social media reflect reality? Social media is full of stories about spectacular investment gains, screenshots of returns, viral success stories, secret tips, and so-called gurus promising big profits. But research and expert analysis overwhelmingly show that what you see online does not reliably reflect real investment outcomes. Reality is far more complex, and relying on social media alone can be misleading or even harmful. 1. Social media often amplifies hype and distorts reality. Social media platforms tend to highlight dramatic, eye-catching content. Algorithms prioritize engagement, not accuracy, so posts showing big gains attract more attention, even if they aren't typical or verified. Financial experts warn that social media can create herding behavior, where people follow trends rather than solid analysis. According to research cited by financial institutions, heavy social media users are more likely to trust and mimic what others promote, creating a distorted picture of success that has little to do with fundamentals like company earnings or long-term value. 2. Many tips are misleading or unverified. Studies analyzing social media investment content, especially on platforms like TikTok, find that a large share of the advice is low quality or misleading. Research found that about 70% of investment-related content on TikTok scored poorly in educational value or usefulness, with creators often more focused on views than reliable financial information. Such content can overstate potential returns, simplify complex risks, and omit critical factors like costs, taxes, or market volatility. 3. Social media can encourage short-term thinking. Academic research shows that social media engagement is linked to short-term investment behaviors, where investors make decisions based on recent trends, fear of missing out, FOMO, or viral narratives instead of long-term strategy. This short-termism often reduces actual portfolio performance and makes apparent gains on social feeds unreliable as indicators of real success. 4. Risk of manipulation and fraud. In addition to misleading content, social media can be used directly for market manipulation and fraud. Regulatory authorities warn that fraudsters use platforms to spread false tips or rumors to inflate stock prices and profit at the expense of unwary investors, a tactic known as pump and dump. Such schemes can make posts about gains seem legitimate when they are part of a scam. Local financial authorities have also explicitly warned investors that easy money claims online often hide high-risk or fraudulent schemes, and that relying on social media tips without verification can lead to significant losses. 5. What research does suggest? Some academic studies find that social media sentiment can correlate with short-term price movements, especially in speculative markets, like initial public offerings or volatile assets, but these effects are not stable or reliable for long-term investing. Investor emotions expressed on social platforms can influence short-term market prices, but long-run financial performance often diverges from social media hype. Another study found mixed effects of social media use on financial satisfaction across generations, meaning the emotional impact of social media investment content varies and does not universally align with real financial well-being. Conclusion: No. What you see on social media does not accurately reflect real investment performance. Viral gains often reflect hype, selective storytelling, or short-term results, not sustainable outcomes backed by rigorous analysis. Social media can shape investor behavior and sentiment, but it is not a reliable source of investment truth. Always approach social media investment content with skepticism, verify information through trustworthy sources, and base decisions on well-researched fundamentals rather than viral posts.